sort of a near-term relief. So without further ado, let's jump into the session straight. Just take note that this presentation is purely for educational purposes only. It doesn't constitute any investment advice. So please do your own due diligence. Okay, moving on. This is me. I think most of you should have known me by now, so I'll just give you a little skip. Okay, so I just wanted to show you again. This is the large speculators futures positioning in the S&P 500. Okay, so you can see from here that I think previously I shared that many of the many of these large speculators, namely hedge fund, they miss out on the rally. So over the past few weeks, we are seeing some sort of a further unwinding in their previous net short position. So if we were to see further unwind, that could really help to provide some form of a buying support. Okay, but for now, it seems that they are taking the opportunity for the recent correction to sort of unwind some of their previous bearish positioning. So something to keep a lookout for. What I'm looking out is whether they can turn from net short to a net long positioning. So that will be something that we can sort of keep a lookout on. And just some of the sentiments indicator that I really wish to share with you. Of course, one is the fear and greed index. So you can easily Google this index from CNN just to show where risk sentiments are. So we know that the S&P 500 sort of formed a bottom around the October 2022, right? And that marks the start of a upward trend in place. How do we see that? A formation of higher high and higher low since then. Okay, and if you just backtrack, if we just match it together with the fear and greed index, generally you can see that since then, it marks the bottom when the index reached extreme fear territory. Okay, and then below 25. Thereafter, in early this year, we hit extreme fear territory again, and thereafter the S&P 500 formed a bottom. Okay, and then for now we are back at that extreme fear territory back in early October. Okay, markets try to rebound. I think the S&P 500 attempt to rebound, and thereafter things were quick to just unwind further. So what I see from this is that when the S&P 500 formed a extreme fear territory in around the early October, I will really want to see that being a key support level to hold. Okay, so where is that? That will be around the 4,200 level. So you can see on the chart, that was the previous low where the S&P 500 formed in early October period. And that is where sentiments also reached the extreme fear territory. So I see that as sort of a key support to really hold for the buyers. And of course, much will revolve around these big tech earnings moving forward, especially into this week. And thereafter, we have the FOMC meeting next week to see whether they could provide some form of a follow-on gains. Hopefully, we are able to see somewhat of a more dovish tone. Recently we have seen the Fed rhetoric kind of shift, right? So previously they were still saying that rates have to be restrictive, but now they are saying that many of them have changed their tone. They are saying that the rising 10-year yields has sort of done their job in terms of tightening, and they are more shifting towards a wait and see kind of approach. So if they were to maintain that, it could potentially be deemed sort of as a dovish tone, whereby we have seen the peak. But of course, in terms of rate cuts, that will definitely be a black box that we have to struggle with. But let's take things as it goes. I think for now, I'm really hoping for the 4,200 level for the S&P to hold for the buyers itself. Okay, moving on, just to share some of the market breadth indicator. Okay, so this is the market breadth. There are many market breadth indicator, but some of it is, the percentage. Okay, the percentage of S&P 500 stocks above the 50-day moving average. So when we look at this, there are three, you can think of it as three lines when we watch. Of course, one is the extreme overbought. where, you can see on several occasions, more than 92% of S&P 500 stocks are above 50-day average. Thereafter, it turned lower. So that is the extreme overbought. We have the midpoint, which is the 50%, just to show, which whether buyers or sellers are sort of in a greater control. Okay, so that's the second line to watch. The last line that we have to watch, particularly at current time, will be the oversold line. So you can see from here, this is the S&P 500 stocks above the 50-day moving average. Currently, it's at 13%. So you can see that once it reach around 3%, then generally things starts to reverse higher. So that may bring about some near-term upside for the S&P 500. We can see that previously this market breadth reaches the 3% level on 4 previous occasions, and thereafter it seems to mark the extreme oversold level. So now we are roughly there. So my thought is that could provide some form of a near-term relief, whereby the room for upside could potentially be better than the downside. Okay, and moving on, this is also the S&P 500 stocks above the 100-day moving average. So the previous slide is on 50-day moving average. Now it's on the 100-day. Likewise, you can mark out some of the extreme levels around the 9.5, 10% range. And then thereafter, you can conclude that sentiments are sort of oversold. So now we are in oversold. Is whether we can get more oversold. But I think for me, my thought is that it does provide room for some form of a near-term rebound. Of course, whether it can follow through, we got to take things as it goes. But for now, it does seem that the reward could potentially be sort of better than the risk, in my opinion. Okay, market seasonality. We have at least got past the weakest seasonality. We know September is the worst. Early October, kind of shaky. Mid to late October tends to be where things could see somewhat of a recovery. I managed to get this from one of the more well-known traders, just to share his findings. October market performance generally towards the end, it tends to be some form of a recovery in sentiment. Okay, so the x-axis is the number of trading days. Currently, we are at number 17. So we are at the 17th trading day of the month. Generally, based on this chart, okay, it shows that around 18 issue marks the bottom. Thereafter, things starts to recover. So we are around there. So it's really whether seasonality will hold through this time round, because we know that when the late October rally starts, generally November, December seasonality is quite positive as well. Okay, and of course, all the debate is around where US 10-year yield treasury is going, right? So, of course, when you have your risk-free rate at 5%, your equities are really seeing a challenge. You got to deliver a sizable risk premium, okay, for investors to buy into your equities. If not, they'll just go for the risk-free rate. I mean, it's safer. It provides a very decent return in multiple years. So that is really gaining a lot of traction. So I think if you look at the US 10-year yield, so if you read all the headlines, it's all talking about 5%. Okay, that is just sort of, to me, is a key psychological level when people talk about 5%. And last night, very interesting, if you look at the US 10-year yield chart around the 5% level, we managed to cross it very briefly. And thereafter, there was a very strong downside reaction in the yield. So what this means is that at the 5% level, there's quite a strong demand for the US 10-year treasuries. So people are looking at 5%. Thereafter, it triggers sort of a huge, you can call it a deep buying in terms of US treasury. So that will be an immediate resistance at the 5% level. And on the chart, I mean, if you are a believer of the bearish divergence, also suggests some sort of a near-term unwinding in terms of the US 10-year treasury yields. So if it unwind further, that could provide some near-term reprieve for our treasuries in the near term. Of course, whether it is a reversal, I think it is too early to say. I mean, just based on the RSI, the daily RSI, you can see that the yield movement has been, the RSI for the yield movement has been trading above 50 generally since May 2023, and thereafter it has been hovering between the 50 to 80 range. So it just suggests that the trend is still upward bias. It's just that near term, it could sort of offer some room for relief. Okay, and moving on, just some technicals. So this is the S&P 500 chart. I think the story this year, the story this week is on, the story this week is on the break below the 200-day moving average. So there was, some form of jitters and all that. But I think we have to take note that back in April 2023, the correction, we also broke below the 200-day moving average. Okay, and thereafter we managed to recover. So yes, of course, it does provide some support for the bears. Generally, the 200-day moving average is looked upon as a key trend line, right? It determines the trend. So of course, but now we are just barely below. What are we watching for? As I mentioned, is whether the 4,200 level probably gives some leeway, 4,150 level, whether this level can hold moving forward. And of course, the US tech earnings will play a very, very key role. Hopefully, we are able to bring away some attention from all that elevated yields. And moving forward, hopefully we are able to see more positive catalysts. I think earnings season so far has been very good. Later I'll show you some stats on, I think companies are still pulling ahead of market expectations in terms of earnings and in terms of a top line itself. So really all ball will be on the big tech earnings, and hopefully we are able to see the October low being defended. And for me, I believe that sort of the risk to the downside is definitely, the reward wise is far greater than the risk in terms of the upside, in my opinion. Okay, Nasdaq, some form of a near-term deep buying. Of course, when you talk about a retracement in the US 10-year yields, Nasdaq tends to be more yield sensitive, right? Nasdaq is particularly growth stocks. Growth stocks tends to be more sensitive to the bond yields movement. So we can see there is somewhat of a deep buying on the lower trend line, and on the downside, I'm also looking at the 14,200 level as probably a key support to hold. And if you were to see, near term, if you were to see further outside, of course, the outward trend line will be in focus. The trend line resistance that has been connecting lower highs will be in focus. And whether we can see a more, a longer term outward trend, that will be the break of this trend line resistance. Okay, and for now, I think generally you can still see that you can argue, the bulls can argue that we are still looking at a bullish pattern in place since 2023. Okay, and whether we can see an outward break above that pattern, that will really provide a signal for a longer term bullish outside move. Dow Jones, a little bit more boring. You can see since November 2022, a sort of a ranging pattern, sort of a trying to move above this range in July, August. Didn't actually sustain, and then things are back towards this form of a ranging, kind of a range, I would say. So not too much action. Of course, if you want to trade the range, you can, but it's definitely more for a short term, because there isn't much signal to me at the moment. And one key thing that you can look out for the Dow Jones, I think the RSI, the daily RSI, you can see since September this year, it has failed to cross above the 50 level. So we tried on multiple occasions. You can see since September till now, hovering below, attempts to move above has sort of were quick to sort of unwind. So of course, one signal is whether we can move back above the 50 level. That could suggest, buyers are really starting to take greater control. But for now, I think things in the Dow Jones still seems to be a little bit more subdued. Okay, and the reason is because Dow Jones generally are mature companies. They pay dividends, and if you have risk-free rate, moving so high, that really challenged the traction for all of these dividend paying counters, right? Same thing for our Singapore REITs, which I will, sort of go through later on as well. Okay, Russell, previously I shared on this 200-day moving average, the very nice blue line where it really tried to hold up the Russell 2000 index on at least 3 occasions. You can see the 3 arrows right there. But thereafter, I think the signal that, my hypothesis is wrong is where it broke below that 200-day moving average. So previously support very nicely, and then thereafter it broke below. So that really suggests that, sentiments have shifted, sellers are in control, and that, sort of the signal to that our narrative is wrong, and the bears are really starting to take control. So now we are closing in sort of on a key support again. You can see that it marks the previous multiple bottom. So one to watch, of course, is for any bullish upside move upon interaction with that key support horizontal level. Okay, spot gold. So I know recently all the headlines on the geopolitical tension in the Middle East that really provide a lot of safe haven flows, and of course, gold has been a very strong beneficiary. So it managed to shrug off that very strong yield movement. So generally, treasury yields and spot gold has a negative relationship. But recently, they have a positive one, largely because your safe haven flows are far overriding that higher yields narrative. But to me, if you were to ask me, I think, of course, for gold, whether the upside can last, to me, I believe that geopolitical tensions tends to provide more of a short-term move rather than a longer-term one. I believe longer-term will still revolve around Fed policies and how high yields will have to go. I mean, if you just take reference to the Ukraine-Russia war back in 24 February 2022, gold prices actually surged more than 10%, close to 15% over the next few months. But thereafter, we know that the Ukraine-Russia war is still ongoing, right? But gold prices starts to unwind thereafter due to Fed policy. So I think for now, it is the sort of the same case. I think a near term, of course, any escalation in the Israel-Hamas war that could, provide some panic, some trigger for safe haven flows, but I wouldn't expect the safe haven flows to last. I mean, once there is much clarity in that space, I think eventually markets will sort of get over it. Similar to what we have seen in the Ukraine-Russia war. I think very little headlines on it now. So over the coming months, definitely, I think, somewhat of the conflict may start to wind down, and that will really challenge whether, gold prices are still attractive given the current yield movement itself. So I wouldn't generally, I think, longer term, I'm more cautious around gold prices. And of course, near term, if you want to trade, you can see that past 2 days, there's a formation of a bearish shooting star. Then that the sort of the signal where, when there's a break below, that could suggest some near-term trade. So I think it's for near-term trades rather than a longer hold. So that's just my own opinion. Okay, Brent crude prices. Previously, I shared, that Ichimoku cloud has been a sort of the very strong support. So you can see that previous two interactions has supported prices, and then now we are on the third time. So of course, this signal is whether Brent crude prices can hold above this daily cloud support. And in the minute where it sort of break below, that could be our first signal that the trend could potentially be sort of shifting to the downside. So that cloud support on close watch in my radar. Okay, natural gas. So previously, I think in recent weeks I did share on a natural gas. Previously was sharing on the higher lows being formed and this sort of ranging pattern and that key resistance around that $3 psychological level. And then I think over the past 2 weeks where we were away, natural gas prices actually seen a very strong surge above that $3 level. It kind of hit the projection, and then thereafter it has a retrace lower. So I think now if you look at the RSI, the daily RSI is still above 50. So I think the the chance that the upward trend may remain is still there. Okay, but I think now what we are looking out for will be a further conviction of a bullish setup, whereby I want to see prices sort of consolidate a little bit, and then for buyers to sort of take control before we load our position. But the previous one has really provided somewhat of a very strong return. I mean, from $3 to the around more than the 3.5 dollars level, that provide a very good double-digit return. So now things are retracing back. Want to watch whether we can actually form a higher low at the moment. So some form of a wait and see, at least for now, in natural gas. Okay, for the currency trader, Aussie dollar, not too much of a action, but it has really been testing that a key support. You can see, hovering above that horizontal support for the third time. So near term, if sentiments are able to improve, that could create some upside for Aussie dollar. But for short-term trade, I believe one I would be watching, of course, daily RSI again. You can see it actually failed to sustain above 50 since August this year. So we got to see a more decisive break above that level. And on the outside, that cloud resistance has also been one of the key obstacles for buyers that I'll be watching. So not too much of a clear signal for a longer term reversal. So now it's around, sorry. Yeah, so now I think it's still that cloud resistance I'm watching. Yeah. Okay, so now let's move on to some of the week ahead preview. So this week is a huge story around the big tech. You can see that whole list of a notable earnings release, starting with Alphabet, Microsoft, and just to see where things are currently. So for now, 18% of S&P 500 companies have released their financials already. The percentage delivering an earnings beat is 79%. So I think this rate of outperformance is still above the 5-year average of 77%, still above the 10-year average of 74%. So of course, some may argue that it's because market expectations are still low. But I mean, a beat is a beat. It still suggests that earnings are still coming in far better than what market are expecting. So that really provides some form of a positive form of a signal. I think previous quarter we have also seen that low watermark being overcome, and thereafter there was this narrative that corporate earnings have bottomed. So that was the past quarter. So into this quarter, I think the key attention will be whether earnings momentum can continue. And for now, it does seem that generally companies are still keeping up with that a positive earnings momentum. Okay, moving forward, we also have the ECB rate decision. So for those trading the euro dollar or the euro currency, this will be on your radar. I think the ECB rate decision, kind of a black box. I think a rate pause is likely a done deal. I mean, previously, the key highlights is around one statement that I have listed here in point number 1. So this seems to suggest that they are looking at a rate pause moving forward, and that is what markets are perceiving it to. And if you look at development since the previous meeting, we are seeing a slowdown in Eurozone September core inflation. We are seeing the recent surge in bond yields that translate to some additional tightening in financial conditions. We are also seeing upside risk to oil prices. So European economies generally tends to be oil importers. So when you have upside risk to oil prices, it translates to greater pressure on their economic growth. So I think the central banks are also having their eyes on oil prices. So all of this seems to suggest some wait and see. It doesn't argue against further tightening monetary policy. I think markets are expecting that as well. So a rate pause this week is likely a done deal. But of course, the focus will be where policymakers, how they will guide in terms of additional tightening moving forward. For the euro dollar, I think recently trying to sort of stabilize from its recent sell-off. Previously, it really has a very huge sell-off from a strong US dollar, but recently trying to stabilize, forming sort of a near-term higher low, and just this week managed to push to a near-term higher high. So some attempts for buyers to really fight back lately. But of course, if you look at the RSI once more, crossed above 50 for the first time in 4 months. So buyers really trying to fight back. But near-term trade-wise, yes, probably a little bit slightly bullish bias. But for longer-term upside, probably the 1.08 level is on my radar to be overcome to provide more conviction. Okay, last but not least, this week we have a very busy economic calendar. We have US GDP, and not to forget the US PCE inflation data. So what can we really expect out of this US data? I think the story, to summarize in one line, is a strong third quarter growth and moderating pricing pressure. Okay, so my justification is, if you just look at the Fed estimates, the Atlanta Fed estimates, we are looking at a strong growth of 5.4%. And our market consensus is at 4.3%. So that is a very strong third quarter growth. Some may argue that, it will fit into the high for longer rate narrative again. But if you look over at inflation numbers, current expectations are for both headline and core inflation to tick lower. So it's a further moderation in line with that softening trend moving forward. So my thought is if you were to see further moderation in pricing pressure, especially in the core PCE price index, which is what the Fed has a lot of focus on, that could really substantiate a rate hold at the November meeting, and also provide room for the Fed to sort of guide for more data dependency, softening their tone in the upcoming meeting. So one to watch. I think for now it does seem that the current expectations are in favor of optimistic numbers coming out from the inflation, the PCE itself. So now we are just looking for a further validation that the inflation trend will continue to soften. Okay, if you look at the US dollar wise, a very strong up move. And I think currently is still, even though there's a near-term exhaustion, but I think it's still too early, to really conclude that we are seeing a reversal in place. I think on the downside, there are still several support, right? I mean, you can look at the cloud support, you can look at the 200-day moving average, and for now, it does seem to suggest there's still a bullish pattern in place. So the worry here for the bulls for the bears, the worries here for the bears in the US dollar will be any break above that downward trendline resistance, that upper trendline resistance itself, because it could mark a continuation pattern of this a bullish panel formation. So this is my view, but near term wise, kind of exhausted at the moment. Okay, Asian outlook. I think a lot of focus will be on the Singapore banks. We have UOB results this Thursday, and then DBS and OCBC over the coming weeks. But all eyes will be on UOB results to provide a glimpse of how our Singapore banks are actually holding up. Year-to-date performance, not too much of a move. You can see it's more of a flat line for all the local banks, largely in line with the broader index. So the outperformer is OCBC, the only one delivering a positive performance year to date, and whereas DBS, UOB is in the red. Okay, what can we really expect? Okay, what can we really expect? I think just basing on the US banks, we can see that the net interest income will continue to be the heavy lifter. And if you were to recall, back at the previous quarter, the DBS CEO mentioned that there's still room for further repricing of loans. So that could roll over into the current earnings. So further repricing could continue to provide support. Okay, but I think some of the guidance will be around that growth risk. So we are seeing that some banks in the region has sort of increased their allocation to loan loss allowance. just to, as a cautious move towards ongoing growth risk. So that will be something that we'll keep a lookout on. So previous quarter, I think our local banks allocation are still very subdued. So if we were to see a pick up this quarter, that could provide a signal that of a higher economic risk in Singapore and across the region. And of course, for bank loans, still very weak. Previously in May, June, there was a slight recovery, didn't really sustain, and July, August, it is back towards that overall downward trend. So kind of a lot of moving parts for the banks. I think the positive is still on that net interest income, that travel momentum, supporting higher card spending. But of course, on the other hand, we also have the risk on loan growth, wealth management, and also the loan loss allowance. And upcoming wise, we have UOB. And we know UOB back in July, the whole hype is around Taylor Swift, right? Taylor Swift concert, and you need to have a UOB card to get that, priority. So we've seen a huge demand of sign up for UOB credit card, of course, and that may help to sort of provide a boost. So if you are able, my thought is that if you are able to see a very positive effect coming from this, that could really help to lay the groundwork for a more positive session ahead. I think upcoming we have Ed Sheeran, right? And same thing, you need to be a UOB card member, if I'm not wrong, to get that priority window to buy the tickets. So if if you are able to show a very strong boost from that Taylor Swift concert, which I think we may, it suggests that they are really doing things, something's right. And that may help to support their earnings in terms of the card spending moving forward. Okay, if you just broaden out our scope to the whole SGX, generally still a subdued net inflows, just really in line with the STI movement of, a more flat line movement, a more ranging consolidation over the past 1 year, okay, or over the past few months, really just on this broad ranging movement. And in terms of the sector breakdown, I just single out the more popular ones, which is your financials and REITs. So REITs has really seen that very strong outflows from institutional investors. It is still ongoing. I mean that higher yields are really weighing on that premium that REITs offer. And financials, I think recently there was somewhat of an uptick in a net institutional inflows. Okay, but much still sort of awaits. I think we are also seeing an uptick in July 2022, and then thereafter it actually unwind further. So I think of course this SGX fund flow data is backward looking, right? So this is as of last week. But it does provide some form of a confirmation that at least for now REITs are still not gaining much traction, and banks are starting to find somewhat of a footing, and largely depending on their upcoming results. So REITs, if you look at the REITs index, form a new low since March 2020. Of course, whether it does provide buying opportunity, I believe that for longer term investors, probably the dividend now is attractive. Okay, but near term wise, you really got to weather through that, that share price. You got to be prepared to experience, a potential downside in share price. But if you are in for the dividends, I think, of course, go for the more stable one, stronger brand names. Over the longer term, it could, sort of still provide a very decent kind of yield return once, the rate hike process has peaked and things are more to the downside for the overall rate outlook. Okay, moving on to other indices in the region. One is the Nikkei. So in today's session, some of a deep buying. You can see that long-legged candle, that daily candle. So after testing that lower channel support, so some deep buyers really trying to jump in. For the upside, of course, that upper channel resistance will be in focus. And Hang Seng Index, another new low this week since October 2022. not really gaining too much of a traction, even though I think we are really seeing some signs that economic conditions are trying to stabilize. If you just look at the third quarter GDP, if you look at industrial production, retail sales, those are healthy. But the weighing part is, of course, the real estate. The real estate risk still ongoing, so that is sort of keeping investors more cautious. But it's really more of a camping and waiting in that sense. So it's more for a longer term investment. And of course, my current stance still hold, whereby that cloud resistance may have to be overcome around the 20,000 key psychological level. Okay, so that's all from me. And just to bring you a broad overview of the economic calendar this week, largely earnings focus. We have some PMI flash data out tonight. Tomorrow morning, we have Australia's CPI that will create some move around the Australian dollars. Thursday will be the ECB interest rate decision, US third quarter GDP. And last but not least, Friday, we have the US core PCE price index data. So a kind of an action-packed week, very earnings-driven, but of course also with some intermittent economic data to keep our eyes on. Okay, so with that, I've come to the end of this week's session. So do scan the QR code and provide some of your feedback, and then to see how to improve, or whether you think there's anything that is worth keeping on. So for now, I'll just go through some of the questions. One is that, do you see the Israel war becoming a factor in the market? My thought is that short-term wise, as I shared, I think any escalation, geopolitical tensions, that will create that flock to safety due to that uncertainty. But when things get clearer, which eventually will, markets tends to price in the effect, tends to digest the effect, and then we get over it, and it's all back down to economic conditions again. So I mean, the Ukraine-Russia war, to me, I believe that Russia's economy is much bigger than Israel, and previously, when there was all that ongoing sanctions on Russia, that worry over oil prices, I mean, Russia is a much stronger producer of oil, right? And there was definitely that few months of a uncertainty. But thereafter, I mean, fast forward to today, how many people really keep their eyes on developments on the Ukraine-Russia front? I think the attention there isn't a lot now. And I think generally, markets may also maybe a few months down the line, we may also get over this Israel-Hamas war. So that's just my thought. Next, Singapore REITs, yes, have gone down quite a lot. Do you think you will continue downside for some more? Can we enter to buy some now? I think, as I shared previously, that Singapore REITs already hitting a new low since COVID period, largely because, I mean, you are able to get a very decent return, right? I mean, in Singapore context, of course, in your T-bills, in your risk-free SSB. So that has really been challenging that traction for holding REITs. Whether we are seeing signs of a turnaround, technically wise, my thoughts are that not yet. Of course, the argument is that you do know how high rates will have to go. I mean, the Fed guide for one more this year, but whether we have really seen that peak, it's still hard to say. We got to see US economic conditions turn much worse, but now it is still very strong. So it's very hard to make a call that rates won't go higher. So I think Singapore rates wise, I mean, to me, I think more of a wait and see at the moment until we are really convinced that bond yields have peaked, and from there we got to see a worsening in terms of the US economic conditions, which I think there's a chance it could take place over the coming months, but we got to be got to see how data turns out to be. Okay, next question on crude oil. How do you see crude oil moving into November, December? Likely to come down because of winter season, geopolitical tension, cooling off perhaps. So I think on the technical front, I'm still looking at that cloud. Previously, just now on the previous slide, I shared on that cloud support. It has helped to support price on the previous two occasions. So that will be the immediate support that I will keep a lookout for. Okay, is it a good time to buy bonds now? Generally, I think yields are really on that attractive front. So if you were to ask me, I think it is sort of a good time to sort of do a little scoop. I think I think that bonds are offering quite a attractive yields, and you when you buy you are just you are getting paid for holding on to it, right? So I mean, why not? So that's my thought, and I think that economic conditions will worsen, and that will really help to provide some traction for bonds. So if you ask me, yeah, I'm more leaning towards a bullish bias for bonds. Okay, next, why go drop with Russia-Ukraine war while increasing? I think for gold during the Russia-Ukraine war, it increased also. Yeah, it increased also. Like just now I showed a chart on the 24th Fed, and thereafter over the next few months, gold price actually seen a huge upside. But thereafter, it tripled off. I mean, the gains start to unwind. Why? Because we are starting to see more clarity on the impact of the Ukraine-Russia war. And second, I think the focus is brought back into Fed policies. So it boils down back towards my stance that geopolitical tensions may not have a long-lasting impact on gold prices. So it's just provide that safe haven avenue in the near term where things are still uncertain. But now I think we are getting more clarity out from there. So I really wouldn't expect that geopolitical risk to have that strong impact on gold prices over the coming months. I believe that markets will sort of get over it just like they did in the Russia-Ukraine war. Okay, so I've come to the end. I think there isn't any more questions. So thank you so much for tuning in. And of course, I will see you next week where we will have a lot to talk about the upcoming Fed meeting. So once again, thank you for joining. And of course, I will catch you next week, same time at 5 p.m. So thank you.